Welcome to Magnifi Plus, where we help you invest with intelligence. I'm Nicole Lapin, former CNBC, CNN, and Bloomberg anchor and New York Times bestselling author. Investing with intelligence is something we all need to do, if not think about, during these volatile markets. Today's guest is Rick Szlec, a senior wealth advisor and managing director at Neuberger Berman in Dallas, Texas. Rick is the #1 advisor in Texas and one of the top wealth advisors in the country, listed by Barron's among America's top 100 financial advisors and teams. Rick, thank you so much for being with us.
Nicole, it's my pleasure. Thanks for having me.
So everything's bigger in Texas. Sounds like assets under management is one of them as well, at least for you. This is not your first rodeo in terms of difficult markets, of course. Everything is down, so correlations are all out of whack. Stocks, bonds, alternative assets, Bitcoin. So much uncertainty now. What's the #1 thing you're hearing from your clients with all of this uncertainty?
Our clients, quite frankly, are paralyzed because they don't know what to do with this inflation scenario. And most importantly, they're very surprised at how much their bond portfolios have declined. Last year, bond portfolios were up plus or minus 1%. And this year, they're negative 5 to 10. So the safe money that the retirees live on and that everyone takes comfort in during down markets has actually punished portfolios more than what's happened in the equity markets.
So what is your strategy for fixed income in an overall portfolio? Of course, you've built such a strong business using this balanced approach of stocks and bonds and private equity. And it's very difficult, as you mentioned, to get a return there. So what would you suggest moving forward as bonds being part of your portfolio?
Well, one of the luxuries of the Fed raising rates the quickest they have in the last 40 years. I mean, the 2-year Treasury is up 5.5 times. The 10-year Treasury is up 10.5 times. That prior to this, to our discussion today, we just had a client invest north of $30 million in a muni portfolio that can earn almost 3% tax-free. So we're seeing opportunities that we haven't seen since the beginning of the year in fixed income. The other thing is we're selling some of the bonds that are actually at a loss. The tax loss harvest that loss and invest in higher coupon fixed income. So it's a very tactical strategy. This strategy I just described has about a 1-year maturity and a 6-month duration. But we gave a client a phone call, and on the phone call, he said, yes, let's go forward. So it's a comfortable place to put money in fixed income, and the opportunity we've seen in fixed income today, we hadn't seen in 12 years.
So are you advising, even for folks who don't have $30 million to put into fixed income, munis over treasuries?
Well, it depends on your tax status. So, and I don't mean to give that number out as any indication whether you have $1 million, 30 million, whatever that number might be, is treasuries, if it's in a tax-deferred account, 2-year treasury is paying 4.3%. So that's an opportunity there. But for most taxable clients, that pay in Texas, we don't have a state tax, so they're paying 37% federal. If you invest at 3%, that's almost a 5% taxable yield, which is higher than you would receive in a treasury.
So you use the word paralyzed, which is an intense word to use as the reaction your clients are giving you based on market conditions. How do you help them become more idealistic, opportunistic, optimistic? How do you turn that paralysis around?
The paralysis really is the result of the uncertainty about what to do. Inflation, clients haven't experienced inflation since back to 1980, right? They haven't lived with interest rates climbing at this rate. Politics are wearing on clients. So that paralysis is very encumbering, and they're looking for an advisor to help them now in a way that they hadn't needed when markets are doubling in 3 years like they did in 19, 20, and 21. So the level of expertise is absolutely critical to clients today when they're working with an advisor who's experienced. Personally, I've lived through inflation in the 80s. I lived through the tech bubble in 2000, the financial crisis in 08, and also the pandemic. So those experiences are so critical for clients. And no matter what wealth level, clients are worried about running out of money. So their number one question is there something I should be doing in order to preserve the capital that I have? And by speaking with them in a human way, we can really move them off this paralysis platform that they've been on really since the beginning of the year.
And you have that human touch. I mean, so much of this is psychological, of course, and oftentimes the greatest enemy as investors is right between our ears. So have you found a psychological approach that works to help clients get unfrozen or unstuck, unparalyzed?
Nicole, you asked a great question. Every client is different, right? Somebody says, I'm 60 years old, I'm 80 years old, I'm 40 years old. The real assistance is to be able to put yourself in that client's position. The most challenging is if you have someone who is successful and sold their business in their 40s and may have accumulated enough wealth for someone in their 60s or 70s to retire. It's very difficult for them because they have a 40-year time horizon and they haven't made a lot of the major purchases and paid for school and other things. So the advice that I would give someone in their 40s is different than someone in their 60s. The real challenge comes also for someone in their 80s or close to their 90s, where if you want to reposition a portfolio, you're going to have a lot of capital gains tax. And depending on their health, if you pass away with a capital gain, you have a step up in basis, which is actually beneficial to them. So it's tricky for everybody, but the communication is critical, but more important is having the EQ of understanding. A lot of us we're hired for IQ because they want smart people in the business, but how do we measure someone's EQ? And that's what's really needed during a time like this.
I could not agree more. I also talk about FQ, financial intelligence, so they probably go to you for that. But you are so high on the charts of EQ, and so much of this is a human business where clients have to feel comfortable telling you about their health, as you mentioned, so that you can properly advise them about tax strategies. Of course, you're located in Texas, which is far away from the Wall Street hysteria and the media right now. How did you and your clients benefit from that distance during what we saw in COVID? And what would you say to our viewers of how to learn from that and put your blinders on?
Well, I learned a lot through the pandemic because, as you saw in Texas, we opened up early. We didn't have a lot of the constraints of a city like New York City. It's a much larger city than Dallas, and they had to handle it in the best way they thought feasible and functional, of which no one had a template, right? And so the small business owner is surviving here, is sort of thriving here, but also I'll share a personal story. I had a home that I decided to sell about 18 months ago, and everyone that looked at it was from California, New York, or Chicago. And it ended up selling to a family from Chicago. And part of the reason was they appreciated the handling of the pandemic and the less restrictive nature of that. So I was able to balance what I lived through here and what I saw my colleagues going with in New York. And what was so disappointing is the COVID just frightened people to such a degree that they stayed in their house for a year, right? And then it made life difficult for them to readjust and get re-enter society. And we didn't, and that all the mental health issues we're talking about. So as we counsel clients, their children, how are your children doing? Do you have, a child in 3rd, 4th, and 5th grade that stayed home for 2 years? This is, as an advisor, we have to protect someone's financial health, but we have to really be thoughtful, sensitive, and caring about what that family is going through. And I always tell my team, you can't learn this in business school, all right? I said, log these events so that it'll make you smarter. And fortunately for me, as I've been doing this for about 35 years, is age is actually a benefit in our industry. So that's been very helpful.
It absolutely is, because you have seen it all, as you noted, with the dot-com bubble and the housing crisis. How does 2022 compare to those previous bear markets with your vast experience?
Nicole, that's a great question. I've thought about it a lot myself. I'll tell you, the market was down, 36% in the first quarter, or all the way through mid-March in 2020. And none of us had ever been through a pandemic. None of us knew about respirators. None of us knew about helping people live on a cruise ship so they can get medically well again, right? And none of us knew the formula. So, 2008 financial crisis was really difficult because that was the financial infrastructure was really challenged. And even I have firsthand knowledge because Neuberger was owned by Lehman Brothers at the time, and Lehman Brothers was the biggest bankruptcy ever. So there was an uncertainty about that time. There's a huge uncertainty about a pandemic. Not to minimize the importance of what's happening in 2022, but the inflation at least has a playbook to it, which we didn't have that for a pandemic or a financial crisis, right? So I am comforted in that. Will the Fed raise rates? Absolutely, they have. The fastest they have in 40 years. The challenge is, will they go too far? And what does that mean? Businesses used to focus on IRR, internal rate of return, and now they're focused on IIR, inflation, interest rates, and recession. Those are the three key terms that I'm hearing from everybody.
Yeah, me too. I've definitely, heard people talk mostly about inflation being the biggest concern. IIR is on top of everybody's mind. You talk about this playbook, though, for inflation, the first I of that acronym. It is comforting to know that there is some sort of playbook here, unlike the guts being pulled out of the system during '08, during unprecedented times. So let's talk about how to approach equities here. We can't look only at short-term bonds for long-term wealth. So what would your suggestion for investors be as they look to round out the equity part of their portfolio?
We're at a really tricky time to put money in equities. You see a lot of the go-to stocks, Microsoft, Meta, Google, Apple, everybody owned them in the portfolios, right? And now most of those stocks are at 52-week lows. Is this the time to invest in securities like that? Who knows, but active management is now, I think, more critical than ever because fundamentals make a difference, right? And so I'm telling clients, if I brought in new money today, we may put 20% in an actively managed equity portfolio in order to not miss days like Monday and Tuesday of last week. In those 2 days, the S&P rose 5.7%. And I can tell you, none of us came to work on Monday and say, this is a good day to put money in equities because we can make 6%, right? And so you can't miss those days. We never know when they're going to come. And you can't just hold cash, or you can hold cash, but it's not recommended. So you have to have some skin in the game. The only difference is it's less than we would have advised a year or two ago.
So let's double click on the second I in the IIR, and that's interest rates. We've seen a little bit of a rally around the idea that perhaps the Fed is done with raising
Absolutely.
rates. What do you think?
Well, if I knew the answer, I'd had everybody's money. All right? No, so my hope, and hope is not a strategy, but the problem with raising rates so high, so quickly in a compressed amount of time is that the effect of that rate increase takes months from now to determine the impact. We are seeing it with mortgage rates. A 30-year mortgage is over 7%. Real estate prices are starting to come down. And I was disappointed the Fed used the word transitory, because all of a sudden when it wasn't transitory, they had to act quickly. So I would hope that the Fed would raise in November and December, take stock and say, let's see how this works, right? But it seems they're really motivated to crush inflation. And how far do they need to go? That's the jury's out. But I will say, once we know where they're going to stop, I think equity markets will rally significantly after that, because we define a huge data point of uncertainty, right? And so that's why I'm saying, when you say how much you put in equities, or invest in equities, it's important to say I can't be all or nothing. So whether it's 20 or 25%, I think it's important to have some skin in the game, because when that day does come, which it will, then you'll see markets rally significantly.
And where should that skin be? Are we talking growth stocks, value stocks, total return stocks within an equity portfolio?
I've done a lot of thinking about this. We equity money that we started to place last quarter of 2021 was more in the value side. And value does well during a period of of raising rates. But growth starts to take off once those rates are, the rate increases subside. So we're actually holding money for clients in growth-related areas of the market, because even though they've been punished significantly, some of those accounts are down 30, 40, 50%. It's our belief that those strategies will rally quickly once growth starts to take hold again.
So value stocks being the P&Gs of the world, Ray Dalio is going all in on P&G. Do you think that that's the right strategy?
Ray Dalio is very smart, and I'm not going to question his wisdom. He's been doing this longer than I have, and he has more money under management. So I'll respect all of that success. Clients do, especially older clients, they like dividend paying stocks. It gave them a coupon, and there's some comfort in that. So that's a good approach, but I don't know that anything is really working right now. And in the future, that might be a better place to go. But right now, I'm not motivated to do that for my clients.
There is definitely comfort in the coupon or in the dividend, that is for sure. Let's finally touch on the R of the IIR, and that's recession. Somebody else who you, I'm sure, know and respect, Jamie Dimon, came out saying that he expects a recession in the next 6 to 9 months. What would you say to him and that?
He and Ray Dalio probably have dinner together a lot, so they're both prominent folks in our financial industry, and I respect Jamie Dimon a lot. I agree with him, right? I think we're already seeing it. We had 2 quarters of negative GDP, and we're debating whether it's a recession. I can tell you, for many folks who are buying gasoline, food, and other items, they're really feeling the impact, and they're slowing their purchases, and they're saying for Christmas or the holiday season, they're not expecting retail to live up to the level. I had one of my clients who has 700 employees in one of the major suppliers to the big box stores. He said he's seeing the big box stores reduce their orders for the holidays 10, 15, 20%. And they wouldn't do that if consumer demand was going to be at a level comparable to last year. So all of those are recessionary behaviors. The question for me is how severe? And we really won't know until it happens. But that's the challenge in all this. And that's where clients are really struggling today, is to know how difficult could it be, because Jamie Dimon said he wouldn't be surprised if we saw a 20% decline from here. Well, I have to tell you, 20% more from here would be devastating, right? When I look at, we track every day where we started the beginning of the year for my assets under management, and we're down at least 20% because bonds aren't working, stocks aren't working. And so that impacts behavior, even for wealthy people. They may travel, but they may not buy a hard asset. They may not buy a piece of real estate they thought they were going to buy. So we're seeing that behavior change. And how do we calculate that to determine whether it's recessionary? We'll find out.
Well, that's for sure. One way or the other, it's all about wealth preservation for you and your clients. Because you say stocks aren't working and fixed income isn't working, what is working? Are you finding more luck in the private equity or in hedge fund spaces, the alternatives?
Right. The alternatives, I have to tell you, during times of adversity like this, we like a lot of the private equity, private debt, secondary opportunities. So the alternative asset space is a place we're allocating to because we're giving the decision making. So those who have allocated capital in these industries for a long period of time, where you're starting to see opportunity. But the difficulty is the acquisition world grew up with cheap money for the last 12 years. So to factor in a 6 or 7% interest rate on a transaction is really changing behavior in a way that we haven't had to pay attention in the past. No one really worried about interest expense. They are today. But that said, the alternative space will really provide opportunities along with fixed income. So if a client has the wealth level that they can commit cash to a 5 or 10-year time horizon, I do believe it's a good time to do that today.
You said, of course, with stocks being equities down 20%, and potentially, if Mr. Diamond is correct, going down more would be devastating. While there could be a playbook, as you know, for inflationary times, unlike the '08 crisis, what happens when you add a midterm election into the mix? We got some more uncertainty with that coming up.
Well, we may have uncertainty or we may have certainty. The market's really like gridlock. And if you find where maybe the House goes to the Republicans, the Senate stays Democratic, you're not going to see major legislation. So you're not going to see major legislation in that regard, and therefore markets like that. So it just adds to the mix. I think more important than that is clients are having a hard time watching their TV, right? Whether it's about political news, financial news, they're really, I'm seeing a sadness that I haven't seen in a long time just because clients have lost money and they're not seeing the opportunity, or they don't know how long this will last, right? And so they're uncomfortable. And I'm talking about people with real money. They're never going to miss a meal, right? They're always going to be able to do that. It's amazing to me to hear how worried they are. So I think the midterm elections, however they go, that's another data point of certainty that we don't have to think about for 2 more years, right? If we figure out what an interest rates are going to be, then we don't have to think about that for a while. So all of those, in my 35 years of doing this, it's the most uncertain period in my career where I have the least amount of vision to do a probability analysis of outcomes. And we didn't even mention the Russia-Ukraine conflict, right? We didn't even mention draining the strategic petroleum reserves, right? What does that mean? And so it's a very confusing time, even though I did mention there's a playbook for inflation. There's maybe not as much of a playbook, especially for what's going on with Russia and Ukraine. And then when you hear about nuclear, when's the last time any of us heard about that, right? So that's very, very disconcerting to a lot of individuals.
Disconcerting indeed. And also the sadness you talked about. We can't leave it there. I'll have to ask you last question about what to do with those feelings of overwhelm and sadness when you're watching the news or watching the shows with the ticker, and the media, has this panic idea that everything out there can be confusing and the messages are mixed. What should investors focus on when they turn on the TV or look at the news?
Well, let me take a step back. If this is the time for folks like me to be more human and to be more thoughtful, to be more considerate, and to be empathetic, right? We have to do our job with managing the money. But it's almost as important to be sensitive to the human element and the feelings these individuals are dealing with. And most of them, I have to tell you, I tell them, don't watch the TV. I said, we're stuck in this limbo period. It's almost a financial purgatory. And I said, we'll figure it out 6-9 months from now. But otherwise, if you're going to be absorbed by all of these headlines, it will probably not make you happier.
That's for sure. Well, thank you, Rick, for your sage and thoughtful commentary as always. Appreciate you.
My pleasure. Thank you so much, Nicole.
And this brings us so nicely to the beauty of Magnifi. It takes all of this emotion out of it. It's just the data, just the facts. So investors can explore financial topics to see what the AI identifies as the best investments based on their searches. So you remember, Rick mentioned opportunities and bonds. So using Magnifi, let's search using some of his ideas. Magnifi is essentially Google for finance. So let's say we search for 1 to 5 year duration government bond ETFs with positive returns. And let's see what we get. So as you can see, it's based on, you can sort by different things, but if you sort by the rate of return, those are the top 3 ETFs that you get. You get Thornburg, Strategic Income, iShares, Short-Term National Muni Bond, and Schwab Short-Term US Treasury. Let's take a look at equities and let's see what we get if, let's say, we search for, I want to buy an ETF for a large cap US value stock. And the results, again, sorted by return. And you can see the top 3 results from Invesco, iShares, First Trust are all energy related. And that's also what Rick touched on. He said we would be remiss to finish this episode without talking about the crisis in Ukraine and the oil crisis. So no surprise here that energy rounds out the top 3. As you can see, Magnifi doesn't just help you invest, it helps you invest with intelligence. And that's really what we want as investors. For more information on anything you've seen here today, please visit us at magnifi.com. Until next time, I'm Nicole Lapin.